Well, it was the most anticipated event of 2015, and in the end, the Fed folded. Yesterday, the Federal Reserve opted to sit tight at their September meeting rather than raising interest rates for the first time since 2006. Here with us today to make sense of it all, Mike Larson, editor of Interest Rate Speculator. Hi, Mike. Thanks for joining us today.
Hey, glad to be here. Thanks.
Well, not only did the Fed not raise rates, as many expected yesterday, they also sounded quite cautious about the global economy and their outlook for inflation. What do you think motivated the Fed's inaction yesterday?
Well, sure. The Fed pointed to softness in net exports, due in large part to the strong dollar, and they also talked about the lack of inflation pressure. And I think most tellingly, they said the following: recent global economic and financial developments may restrain economic activity and are likely to put further downward pressure on inflation.
Sounds like the Fed is worried about slowing global growth, specifically China and other emerging markets, but isn't this also a vote of no confidence on the U.S. economy too?
Well, yeah, they're absolutely concerned about what's going on overseas, and that clearly is overshadowing some of the happy talk about the domestic economy they tried to throw in there. You know, They said the economic activity is expanding at a moderate pace. They talked a little bit about good news in housing, but overall, at the same time they said that, they lowered their forecast for future growth and inflation, even here in the U.S., and that says volumes about what they really think.
Yeah, not good news. And this means probably expect lower rates for much longer, but is that good for stocks?
Well, theoretically this was a dovish statement, but ultimately I think it's bearish for risk assets.
Why is that?
Well, look at this. I read the statement they released after the meeting, and I listened to Chairman Janet Yellen's post-meeting press conference, and I was left asking a simple question. What is the Fed so afraid of? Are things so bad in the world that we can't get off 0% a whopping 7 years after the depths of the credit crisis? How is that long-term bullish for the economic outlook, for corporate earnings, or stock prices? And I'd say it's not.
Indeed. Mike, there's been plenty of wild market swings, too, over the past several weeks, prompted by all this uncertainty about the chances of a Fed rate hike, will they or won't they? But hasn't the Fed just prolonged all that uncertainty even more?
Well, exactly right. The Fed had a chance to put an end to this policy guesswork by starting the rate hiking process, and they didn't. So that means we're going to be stuck in this will they or won't they environment for the foreseeable future. That's creating uncertainty, and it's going to magnify those unintended negative consequences that we already have from leaving policy too easy for too long.
Yeah, here we go again, right? We've seen easy money policies in the past inflate the dot-com bubble in the 1990s, for example, or the housing bubble, which you correctly reported on in the 2000s.
Yep.
Both of those ended badly for investors. Are we in for more of the same here?
Well, exactly. We had those two experiences, and now this time around, we've seen massive speculative activity in commercial real estate. We've seen a giant surge in junk bond valuations and issuance. And we've seen this torrid pace of corporate debt offerings. But the funny thing is, companies aren't using that money to hire workers or build new factories and stuff. They're just taking that money and plowing it into stock buybacks and M&A, which is good for shareholders, but not for the real economy. So I think because the Fed didn't act soon enough to nip those budding bubbles, we're stuck in this situation where they're going to pop too. And, again, we're right back to square one.
So what's the bottom line here for investors who are trying to navigate these difficult and volatile markets?
Sure. Well, anything can happen with the markets in the very short term. Yesterday after the Fed news came out, the Dow dropped briefly, then it surged more than 170 points, and then by the close it plunged all the way back to minus 65.
Right.
But if you get beyond those short-term gyrations, I don't think the Fed's non-action is ultimately bullish for the real world that we all live, work, and invest in. And moreover, it's also bad news for financial stocks. You had investors that were buying some of those stocks on the belief a Fed hike would actually help boost the net interest margins they make. But obviously that idea just went out the window with this no taking of action.
That's great insight, Mike. Thanks for being here and sharing it with us today. And for more details about Mike's Interest Rate Speculator, simply click on the link below. Thanks for joining us for Money and Markets Extra, and until next time, good investing.